Welcome to our Axios Pro virtual event. I'm Richard Collins, retail reporter with Axios Pro. Welcome to our audiences on Facebook, YouTube, X, formerly known as Twitter, LinkedIn, and on Axios.com. Join the conversation today on X with @Axios Pro and hashtag Axios Pro. Over the next 30 minutes, I will be joined by my colleague, Kimberly Chin, and we'll deep dive with deal makers on M&A hotspots in the sector. Our first guest is the chairman of Growth Beverage, Brian Rosen. Thanks for joining us, Brian.
Pleasure to be here.
When we previously spoke, I believe you said you're the third generation of your family to be in the adult beverage business. Tell me a little bit about your background.
Well, I'm a lifelong beverage guy. My family was the very first liquor license handed out in Chicago after Prohibition. From there, we grew that one single store to the nation's largest retail liquor store, doing $100 million in revenue annually. We sold that company to a private equity firm. I went on to PricewaterhouseCoopers and ran the adult beverage division for them. From there, founded a company called BevStrat, which I later sold to another private equity firm. Then founded InvestBev, founded Sprout Beverage, founded Algoma Capital. Altogether, if you look at generations, we've been in the booze game since 1933.
Wow. Now, Growth Beverage has a few pieces to it, such as InvestBev, and there's some news there I want to discuss later. But for now, could you tell me a little bit about each of those businesses and name them?
Sure, of course. Growth Beverage is the parent company, which would imply that everything we do under Growth Beverage is about growth. And as a person who has seen brands come and go throughout my career, I've become an advocate for the small brand. So with that, we've got BevStrat, which is a sales and marketing company that puts full-time bodies on the ground for brands all over the country. You've got InvestBev, which right now is roughly about $250 million under management. And we invest in brands and we buy raw distillate. And we buy support services or invest in support services. There's Algoma Capital, which is a $100 million credit facility for distilleries to use and to borrow with. And then finally, there's Sprout Beverage, which is a brand incubator and accelerator that, because of the challenges of the adult beverage business here in the U.S., we've become a little bit of a beacon or a shining light for people wanting to get in this business and giving them the tutelage and the boot camp they need to have success.
One of the more interesting parts of your portfolio are your holdings of raw distillate, which I believe would qualify as an alternative investment class, if I have that correct. What is it exactly, and how did you get into that?
Right. So what I like to say, it's the thing that makes the thing. Raw distillate is what distilleries produce that then becomes whiskey. But the middle piece of that is age. You produce raw distillate, any distillery can produce it. And then your raw distillate for bourbon or whiskey sits in these barrels for 2 to 3 to more years. And then it, at that point, gets bought by someone else who turns it into the finished product. Many people don't know, for instance, that Bullet Bourbon, up until recently, did not even have its own distillery. It bought spirits or raw distillate on the open market. So what we have done is we have said, okay, if this is a necessary evil, meaning that distilleries don't want the raw distillate anymore, and it's not ready for the brands yet, there's a middle piece here. And this is exactly where InvestBev plays. Right now, we currently own about $150 million worth of raw distillate, aging and laying down around all over Kentucky and Ireland. And then we are preparing it for sale to the people who need the finished product. And then they will themselves go ahead and finish it and turn it into the brands that you see on your local retailer.
Very interesting. Now, how big is that space? Are there a lot of investors? Is that a fragmented space?
It used to be, this guy selling to this guy in 10 barrels at a time. But we're buying 5, 6, 10,000 barrels at a time, and we're writing checks regularly for between $5 and $20 million. So it was very fragmented, to your point, Richard. What it's become now is a little more of an investable asset class. And there are a lot of players in the game. But what I would say to anyone who looks at the asset class, it's a great class because it's non-correlated. It's not tied to anything stock market, not tied to unemployment, not tied to who's in office. It's just very uncorrelated, and you need that in your portfolio. But before Mr. Deep Pockets runs to Kentucky and gets involved, the important thing to understand, it's not as much about how you buy it, it's about how you sell it. And if you're not from the space, or if you're not a generational player in the industry, it's very hard to sell it. And so you don't want to get stuck with 1,000 barrels. So we have a unique advantage, I feel, that we both know the entry and the exit partners oftentimes. And that makes us kind of a pretty safe partner, I guess, when it comes to investing in this asset class.
Got it. Now for a fun fact, you have an interesting statistic on the percentage of people who participate in dry January. We were talking about this before.
Yeah. It's 1% of the overall, less than 1% of the overall consumption public. I myself have made it to January 3rd and 4th twice. It's not an easy. Dry January is very top of mind right now. Non-alc and low alc are very hot in the consumer's psyche or lexicon. But the reality is that even if it's at 100% capacity, it's still 1% of the consumption public. It's a 17, 18, $20 billion industry, and rolled up all the non-alc consumption is, $10 million, $20 million type of thing. So I see it as a great movement for the health of the consumer. I do not think of it as an industry changing movement that will take Jim Beam out at the knees. It won't happen.
Fair enough. And you actually answered several questions right there, because I was curious, just to drill down even a little bit further, to what extent are consumers moving away from alcoholic beverages? And certainly the non-alcoholic space has gotten a lot of attention from some of the big distilling giants like Diageo, for example. So I was curious what your thinking there was about that.
Yeah, you have to, if you're Diageo or Constellation or Pernod Ricard or SAB Miller or Anheuser-Busch, you need to have these things in your portfolio because, like anything, there is a shoe for every foot, right? But the reality is not everyone's buying size 20 shoes, or not everyone's buying size 3 shoes. That audience is there, but it's very limited. So you want to have that in your portfolio, so at least you get that share of wallet, but it's not a focus. It's never going to be a driver. And I'll tell you anecdotally, last year, a store opened up in New York City that sold only non-alcoholic brands. And it had the busiest January it's ever had. And it went out of business in February, right? So wow. Anecdotally, non-alc is a thing, but it's a moment in time we're having right now. It's not a forever thing. There's too much money at stake and too many varying opinions about non-alc and all of that, and zero and low proof, for it to be anything other than an adjunct to the regular drinking population.
Fair enough. I do want to zoom out just a little bit here. Beverage generally, not just alcoholic, has been pretty active in terms of M&A between independent distillers, craft brewers, non-alcoholic, as we were talking about, functional beverages, and sustainable water brands. You kind of already spoke to this earlier about the advantages, particularly of investing in the alcoholic space. But I do feel like maybe that applies to beverage as a whole. What do you think is driving all that from a consumer and investment perspective?
So the question is, why is M&A so hot in beverage? Yeah, well, think about it.
And do you think that's going to continue? I mean, what do you think from a consumer's perspective is driving that? What do you think makes beverage attractive?
Well, there's nothing in the world that's recession proof. That's a baloney line. But if you think about it like this, during COVID, the unemployment rate was over 17%, yet the spend on adult beverage went up 6%. So just think about that. Also think about that during COVID, which I know was a moment in time, but it's our most recent huge data point, that liquor stores were deemed essential businesses the same way that gas stations, hospitals, and grocery stores were. Liquor stores. So when I look at M&A activity, and if I'm an investor, which I am, and we're one of the larger ones in the country, I'm investing in an asset class at the 30,000 foot level that is, again, I don't, the word is, take the word with a grain of salt, but recession proof, stable, has been growing consistently since 1933, and is an industry that everyone can understand. Your investors, your limited partners, the public markets. I'm not talking about solar wind. I'm not talking about cannabis farms. I'm not talking about bio farm and all that. I'm talking about all you need to do is go into your favorite restaurant, wherever in the world you are, and you will see a drink of something on every table you pass. Who doesn't want to be part of that? It's an easy to understand, easy to, excuse the pun, digest industry.
Are there trends we should be watching right now in beverage? What areas are most interesting to you?
Well, we talked about it, right? If you can ride the non-alc wave for a couple of years, you're going to be in good shape. Obviously, tequila is hot, but I think there's some blowback on celebrity tequilas. Brown spirits are hot because there's a rarity to it. You've got more demand than supply, so that people feel every bottle they have is an event. So that is a very good sessionable activity. I also think that the person who can solve the e-commerce problem of shipping booze across state lines and e-commerce related to the internet, as far as ordering liquor online, that's going to be a hot category, whoever figures that out. But overall, in general, I feel as though, and our investment thesis will show this, if you can create a brand that is multi-state distribution, selling 5,000 plus cases, appeals to the consumer sense of self, and is at an affordable price, and you have got buy-in from both distributors and on and off-premise retailers, then you have a winner in some capacity, and we want to be part of it.
As we wind down here, I have a couple more questions. The first question I want to ask here, you also invest in other areas outside of, or that touch on adult beverage, such as e-commerce. Can you tell me a little bit about that? What's interesting there?
Well, the brands themselves are very interesting, obviously. We're a big, as an investment thesis, we're a very big picks and shovels kind of firm. What I would say is, if you're a concrete manufacturer, you don't care necessarily if you're making a pool, a sidewalk, or a highway. We're no different. We want to invest in the things that make the things. So whether it's glassware, whether it's closures and corks, label makers, distributors, infrastructure things. And for us, those are always the things that are very interesting to us, because we're not so reliant on the success individually of a brand. We're more reliant on the thing that makes the brand, because at the end of the day, that's why we like raw distillate. I don't care necessarily if you're making Jim Beam or Jack Daniels or Basil Hayden or Booker's or Knob Creek from the thing. All I know is you need the thing to make those 5 brands. And for us, those are very sexy investments. They're very attractive, and they're very accretive to our portfolio.
And then just finally, you closed a $51 million fund for InvestBev recently, I believe, and then a $100 million fund for Algorama to provide credit. Tell me a bit about those. And then there's another on the horizon that you're planning to raise. We just have a little bit of time left here, but I was curious for you to touch on those.
Sure. We have a $150 million fund that's opening up at the beginning of the fourth quarter. The same thesis as our Fund 3, which is barrels, brands, and support services, because there's a need out there. There's a desire, and the investor is looking for non-correlated assets. Algoma Capital is a $100 million debt facility because banks don't like to lend into the industry. And so we're almost friendly fire. We're from the business. We understand what it takes. We understand the asset class, and we're affordable. So Algoma Capital is set up to lend money to distilleries and people who own raw distillate. And finally, we did just close our $51 million Fund 4. We're nearly halfway deployed on that already. That's barrels only. And that will hopefully have the same successful outcome as our Fund 2 as it returns capital currently. So we love the space. As we've talked about at the top of the show, having been in the space since Prohibition, or personally, I'm 53. So since I've been 18 years old, we know it's got value for the consumer, and we love being here.
Thank you so much, Brian, for joining Axios today.
You got it. You got it. Thanks for having me.
And next over to my colleague, Kimberly Chin.
Thanks, Richard. I'm Kimberly Chin, retail reporter for Axios Pro. Our next guest is Kathy Leonard, partner and co-head of consumer retail for Salomon Partners. Hi, Kathy. Thanks for being here today.
Thank you, Kimberly, for having me.
All right, so I'm going to throw a stat to you. Consumer retail M&A deals fell 12% quarter over quarter, and M&A activity for the first half of the year is said to be at the lowest level since the start of the pandemic. Have we hit the bottom?
I believe we have. I think we're at a unique point in history. We've seen the tail end of all the government and Fed tightening. We've seen interest levels go to their highest rates in 22 years, and deal volume fall to the statistics that you've mentioned. I do think we're at a pivotal point in the M&A market.
So then that means that the only way is up, right? Where are some of the bright spots that you're seeing?
Well, as an M&A banker, we have to be optimistic. But fundamentally, what you see is CEOs and businesses, when the economy stabilizes and the market stabilizes, you do see more activity. You mentioned down 37% year over year. It's more dollar volume driven than transaction volume driven. Where are the bright spots? Couple of things in our sector. You've seen more recently, and you've seen volume pick up, and I know you're going to ask me about it, but we saw a resurgence in high-end fashion and apparel deal making. We saw Tapestry do an $8.5 billion acquisition of its rival Capri. We've seen Advent and its majority stake in Zimmerman. So seeing this resurgent in the apparel industry has been quite interesting. We've also seen a lot of deal activity out of the brand licensing firms. They continue to raise capital and execute on M&A transactions. We saw ABG, we saw WHP and others do a lot of activity. And then obviously there's the exciting and large scale transaction where Subway was acquired by Roark Capital. And that's a big one. That's a $9.5 billion transaction. So that does tell us there are signs of life out there in consumer discretionary.
Speaking of Subway and just the sheer size of it, what do you think got the deal across the finish line?
Well, according to the press, obviously the sellers had higher value expectations. I think, well, there's an earnout, and a lot of times we see earnout as a significant bridge to value expectations between sellers and buyers. And this one had a $600,000 or $600 million earnout that took the transaction up to the $9.5 billion, and I think that's part of it. There's also an antitrust breakup fee in this transaction, as we've seen. The FTC has been quite hard on deal making, and we're seeing the rules change, but that's certainly an indication that there's more deal making to come when we see deals of this size.
How concerned are you about antitrust?
Not terribly. The rules are going to be significant. I think most importantly, the new merger rules that we see coming as the FTC and DOJ propose these changes to the merger rules. I think it's going to do two things. It's going to require more transaction information and longer merger delays. Will it slow things? Hopefully not. I'm trying to be optimistic on the heels of a weak 2022 market. There haven't been changes in the merger rules for many, many years. This is a new thing. It's just going to take longer and being more expensive for deals to get done.
And how are you communicating those changes to your clients? Those expected changes.
We work closely with clients' counsel to communicate the rule changes. It's also in the preparation and process of a deal. What information do you share? What's sensitive? How do you get all the information in advance so that the process of clearing the FTC goes more smoothly? It's similar to any M&A process. It just adds more to the process and the deal making and the data collection. And you have to be careful. You have to be very sensitive to what looks like competitive, anti-competitive, and presenting the information carefully, not sharing information that creates competition concerns.
Turning back to the Subway deal, this is believed to be one of the year's biggest private equity deals. You had TDR Capital, Sycamore Partners, even Goldman Sachs in on it. What does this say about private equity's ability to execute deals?
I think it suggests that they think the market's stabilizing. They think the consumer's stable. They don't think interest rates are going to continue to rise. If you step back and think about all the factors that slowed down deal making in consumer discretionary last year, high interest rates with no end in sight, the threat of a looming recession, global factors, and there just seemed a whole host of factors that weighed on deal making in 2022. And as we look forward, what we're seeing is we do expect the rate hikes to slow down. GDP is strong, and frankly stronger than the Fed would like. That's why they're continuing to hold out this threat of increased rate hikes. The employment statistics are really strong. So what we've seen is this great fear of a looming recession, but that is waning in this market. And what you'll see is that will contribute to increased deal making as we go forward, I think, in the back half of 2023, heading into 2024. And what we've said consistently to our clients and our community is that when the markets stabilize and the Fed stops increasing rates, then we're going to see a return to deal making. And I think that's what you're seeing.
Given the high price tag of the deal, does it suggest that the finance environment is also loosening?
That the financing markets, well, we have seen, some strength. What we saw propping up the deal market for a long period of time was the private debt markets and the direct lending market. That was a very strong bright spot, particularly for the middle market. The change we've seen is that the broadly syndicated market and the bank financing markets have opened up, and that's going to really fuel some of these larger deals.
Got it. Switching a bit, Richard and I have been having these conversations about companies pretty much pursuing this dual track, so both an IPO as well as an auction process. An example that comes to mind is Fogo de Chão. They filed an S1 late last year, but also pursued a sale early this year, and it ended up getting scooped up by Bain Capital. Are we going to see more of that?
Well, there have been signs of life in the IPO market, and I think that provides an opportunity to pursue various exits. And if you think about the slowing of the deal market, what that means is sellers just don't have an exit, and that can only last for a certain amount of time, so they can either sell in an M&A transaction or sell, or monetize through an IPO. And I think the signs of life in the IPO market are also going to fuel the M&A market. The equity market's been strong. The NASDAQ is up 28%. We've seen some very successful IPOs. We saw Kava. We saw some other sort of tech-related M&A transactions. And importantly, there are rumors of a lot of other high-profile M&A IPOs that are on the docket, but I think activity begets activity. And to your point, folks will pursue an exit, whatever is going to generate the best value creation for them.
Do you then think that the IPO market is open at this point?
I think it is weird. Well, it's not open right now. As you know, there are windows of the IPO market, but I think the strength in the equity markets and the success of, some of these IPOs, whether it's, Savers or Oddity, which I think was very interesting, Kava, folks are cautious. And what you're going to see is really strong brands and companies hit these windows when the markets are strong and the markets are open. So it's going to come in pockets.
Are there particular areas that you think are primed for the public markets?
Well, I'd rather see there be M&A transactions. I think that's a much more exciting place to be. It's been interesting, Kimberly, private equity has not taken a lot to market lately. You've seen a few, but what's been interesting in the sponsor market is they took a total shift from consumer discretionary and how they invest in the markets. And this has been an interesting element in deal making. And they went into more services related businesses, whether it's residential services, consumer services, anything that has a recurring revenue. So as investors became concerned about the economy, concerned about a looming recession, higher interest rates, how all these things, inflation, how it was going to impact, how these things were going to impact the consumer, they shifted investment dollars to these businesses that have more of a recurring revenue. So it's still consumer spending, but more of a recurring revenue. So a lot of the deal activity, particularly in the private markets and the sponsor markets, has leaned into that. It'll be interesting to see what the exit opportunities are for those assets. Are they going to trade to other private equity, or are there going to be more consolidation? Or can those businesses get to scale and go public? I think when you look to the future, you have to look at what the recent deal activity focused on and what's going to happen there.
What are some of the other types of M&A transactions that you're seeing take flight?
Well, as we mentioned, it's been very heartening to see this return of deal activity in consumer and soft lines and apparel. And it's largely been at the high end. We do think there's going to be more activity where there's a high-end consumer, particularly in high ultra net worth consumer. The other piece we talked about, these brand licensing firms have been very prolific in their M&A activity. You saw WHP buy Bonobos, ABG buy Boardriders, Vince, Hunter Boots, and a whole host of things. And then a smaller transaction, which recently occurred, is Consortium's acquisition of Draper James. And what's happening is this is an interesting way to play consumer discretionary, because all of these businesses, these brand licensing businesses, are building up massive war chests to do acquisitions, because again, it goes back to that theme of recurring revenue, because they're basically licensing businesses and they collect royalties. So that's an interesting aspect in terms of our practice and where we're seeing a lot of deal activity. More broadly, we continue to see a lot of activity in better for you foods. That's still a hot category. It's more of a middle market category. We're seeing beauty, health, and wellness. And then the last piece I think that's interesting is the carve-outs. We've seen a fair amount of activity on carve-outs of businesses. We just sold some businesses for Walmart, but you're seeing that across the board as strategics evaluate their portfolios and optimize the business for this current economy. And we expect that to continue to generate considerable deal activity.
Is there anything else you're looking forward to the rest of the year?
We hope there are no more rate increases, and that we can stop talking about a recession, and that this really moderating of interest rate increases happens. and that the Fed doesn't increase further, because I think our thesis has always been that, once all this stops, then the deal activity will pick up. And that's an important component of what we do is timing this. When's the right time to take assets to the market? We feel good as we head into year end and beginning of 2024 that conditions are going to improve. And what we see is a lot of preparation out there for launching new processes in the market.
And just in terms of just the biggest M&A opportunities right now, can you sum up what you think those are?
I think it's everything we've talked about, but what we'd really like to see is the investment community, kind of shift from this risk-off position. Consumer discretionary is such an important part of GDP, and go back into more risk-taking in consumer discretionary, because the consumer is proving to be pretty healthy in this economy. They are spending, they have jobs. And so we think kind of shifting back to some of the deal making we saw beforehand, there will continue to be investment in recurring revenue type businesses. We believe in that. But, back to more traditional consumer retail deal making, that's what we're looking forward to.
Great. Well, thank you. That's the end of our time. Thank you, Kathy, for sharing your insights.
Thank you. It's a pleasure.
Thank you all for joining us this afternoon for another virtual conversation that has made everyone smarter, faster. For the latest on retail deals or to subscribe to Axios Pro, visit axios.com/pro. Thank you all for joining, and we'll see you next time.